Hey everyone, and welcome to AB Study Partner, your best spot for, making those tough subjects just a little bit easier. Today, we're jumping headfirst into the world of tax law, and I promise you it is way more interesting than it sounds, because we're going to talk about money, biscuits, and of course, the tax man. So let me kick things off with a question that sounds kind of nuts. Can a simple biscuit tin actually get a company into serious trouble with SARs? I know, it sounds ridiculous, doesn't it? Well, you're going to want to stick around because the answer is a huge yes, and the story behind it teaches us one of the most fundamental rules about what counts as income. All right, let's set the scene. Our story is all about a company called Pyott Limited. Now, these guys made biscuits, and they cooked up what they thought was a really clever plan for the tins their biscuits were sold in. So here's how their little system worked. You'd go and buy their biscuits, which came in a pretty decent tin. You'd pay for the biscuits, naturally, but you also paid a small, separate fee just for the tin. The whole deal was, if you brought that tin back without, running it over with your car, you'd get that fee refunded. Simple enough, right? It's just a classic deposit system. Okay, but then tax time rolls around. And Pyott goes to the tax man and basically says, hey, you know all that money we collected for the tins? That's not really our income. We see it more as a liability. And a liability is just a formal way of saying it's an IOU. It's a debt they might have to pay back to customers who decide to return the tins. And this right here is the huge, massive legal question at the very heart of this whole biscuit saga. Is a refundable deposit, money that you might have to give back, is that considered part of your gross income the very second it lands in your bank account? This is literally the multi-million rand question for countless businesses out there. Now, Pyott's argument, it seems pretty logical, doesn't it? But SARS wasn't convinced, and the whole thing went to court. And let's just say the court had a very, very different opinion on the matter. And its decision ended up shaping South African tax law for decades. The court took one look at Pyott's argument and gave them a hard no, a big, fat, definitive rejection. They basically said, sorry guys, you've got this all wrong. The money you got from those tin deposits, yeah, that's income. But here's where it gets really interesting. The court's reasoning. They made a critical point, and you can see it in the quote here. They said the money wasn't trust monies. That's the magic phrase. Pyott wasn't just holding the money for its customers. They were receiving it for themselves. You see, for the court, it was all about timing. They said the exact moment that cash hit Pyott's account, bam, it was income. The whole what if about a potential refund, that was a separate issue, a problem for another day. When it comes to tax, what matters is the here and now. Okay, so this whole story builds up to a huge legal principle that you absolutely 100% need to know for your exams. This very case gave us what's now called the for your own benefit rule. And this definition is everything. For something to be part of your gross income, it has to pass a two-part test. It must be received by you on your own behalf and for your own benefit. It's not enough for the money to just land in your account. The real question is, who does that money truly belong to at that moment? So why did Pyott's tin money meet this test? Well, because once they got that deposit, they could do whatever they wanted with it. They could mix it in with all their other money, use it to pay salaries, buy more flour, anything. They were the beneficial owner of that cash, even if they had a side deal to maybe refund it later. All right, so to make this super practical for you, let's break down the different kinds of deposits you're going to see out there. And it all boils down to one simple question. Is the money you're holding a treasure you can use, or is it something you're just holding in trust? Check out this table. It makes it super clear. On one side, you've got treasure, money you get for your own benefit. It's yours to use, and it's immediately gross income. That's the Pyott tin money. But on the other side, you've got money held in trust. Here, you're just a custodian, kind of like you're babysitting the cash for someone else. A perfect example, a rental security deposit. That is not gross income for the landlord. Let me give you an even simpler way to picture this. Think of Pyott's tin money as their own personal pocket money. They could spend it however they wanted. A rental deposit, though, is more like if your friend gives you an R50 note and says, hey, can you grab me a Bori roll later? Sure, the $50 is in your pocket, but it was never actually your money to spend on yourself. So how does SARS actually tell the difference in the real world? Well, they've got a kind of checklist. First, they totally ignore what you call the payment. They look at what's really going on. Second, just sticking the money in a separate bank account doesn't automatically mean it's trust money. And third, and this is the big one, it always comes back to that killer question. Who is the true beneficial owner of the money? Okay, I can practically hear you thinking it. This is a case from 1945 about biscuits. Why on earth should I, a student living in the 21st century, actually care about this? And you know what? That's a totally fair question. And here's why it matters so much. This principle is alive and well and being used by CIRs every single day. It's what decides if a deposit you take from a client as a future lawyer or from a customer if you start an online store, it decides if that cash is taxable income from the very first day. And trust me, getting that wrong can have massive, painful financial consequences. So, we're going to leave you with this final thought. The next time you pay any kind of deposit, for your rent, for a service, whatever, just pause for a second. Ask yourself the question we learned today. Are you handing them treasure that's now theirs to use, or are they simply holding your money in trust? If you can answer that, you've just nailed one of the biggest ideas in gross income.